We're going to talk about the economy now. Today, the Federal Reserve raising interest rates by 0.5%, a slower pace than previous months, and its 7th rate hike of the year.
Fed Chairman Jay Powell explaining that move in a press conference a little while ago. Take a listen, see if you can figure out what he's saying.
Today, the FOMC raised our policy interest rate by a 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time.
No.
That's a good question. Okay. Well, that wasn't too bad, but let's bring in ABC News business reporter Alexis Christoforous to join us with more. Now, I facetiously said, see if you can understand, because traditionally Fed chairs speak in somewhat opaque terms. Powell's a little different, but more important, Alexis, what's the headline from the Fed chair so far today?
Yeah. We call it Fed speak, and no matter what words you use, the bottom line is it just got more expensive to borrow money, Terry, from credit cards to home loans, small business loans. If you're trying to take out a loan to buy a car, all of those things are going up because the Federal Reserve deemed it necessary to raise interest rates again. Remember, what they're trying to do here with these rate hikes is to slow consumer demand, slow the economy enough to bring inflation in check to that 2% level he was talking about. We found out this week inflation is at 7.1%, so still too high for the Fed's liking. And so they not only signaled that, they're raising rates today, but they signaled that more rate hikes are to come.
Well, digging a little deeper on what you just said, interest rate hikes make things more expensive for a lot of people. We know that, right? We're all feeling it. But as you sort of touched on there is another side to consider with regard to who it helps.
Exactly, and it actually can help. Remember when we would put money in the bank and say, I'm not making any money on my money, and we were saying that for a really long time, and now that has changed. So we are seeing savers getting about 4% on their money in savings accounts, certificates of deposit. That's the highest rate we've seen for savers in 15 years. So the good news is if your money is in a money market account, a savings account, it is starting to make a little more money than it had been. So wanted to offer that sort of silver lining there. But as you can see here by this graphic, we are still paying $396 more this month for the same goods and services that we were buying just a year ago. So again, high inflation continuing to put the squeeze on household budgets.
That definitely is getting people's attention still. And as you say, savers will make more money. You got a lot of debt on your credit card. You're gonna lose in this environment. But let me ask you about when enough is enough, right? We're seeing signs inflation may be easing. So what are people saying about when these rate hikes might wane down and even reverse? Is there a timeline on that?
Well, the Fed gave us some clues about that today. It looks like, basically, Fed Chair Powell said their job is not done. They want to see inflation come down to that 2% rate. Again, we're at 7.1%. So we're baby steps here, right? These 7 interest rate hikes so far this year starting to trickle now down through the rest of the economy. We saw gas prices come down last month, airfares, used cars, all coming down. Not fast enough for many of us, and we still have rent and grocery prices are still high. So the Fed has more to do to bring inflation under control. They're already signaling more rate hikes next year. They believe the unemployment rate will have to rise from its current 3.7% to 4.6% by the end of next year. And some economists are now saying we probably won't see the Fed reverse course and start cutting interest rates until at least 2024. So again, if you are carrying credit card debt, make it a priority to get that debt down as much as possible. And if you can, save a little more each month for a rainy day fund or emergency savings.
Well, I think she just answered our last question.
Yeah.
If you're talking about 7 rate hikes in 2022, when is enough? And, will it keep happening? Because we are concerned about the new year coming up.
Absolutely. And the Fed continues to walk that fine line, Kira, because it wants to slow the economy enough, but not so much that it dips us into a recession. The silver lining here is we still have a very strong job market. Wages are higher and consumers continue to spend. If that can all hold up, even in the face of higher interest rates, we might be able to avoid a recession, or if we fall into one, it will be hopefully a mild and short-lived one.
Well, let's hope. Alexis Christoforous, as always, thanks very much.
Thanks, guys.
Hi, everyone. George Stephanopoulos here. Thanks for checking out the ABC News YouTube channel. If you'd like to get more videos, show highlights, and watch live event coverage, click on the right over here to subscribe to our channel. And don't forget to download the ABC News app for breaking news alerts. Thanks for watching.